I'm Chase McWhorter, Managing Director at IREI, overseeing our infrastructure division. For those of you less familiar with IREI, we're a global media firm producing investor-focused content on the infrastructure and real estate asset classes. Content is in the form of our monthly publications for infrastructure, that's institutional investing in infrastructure, also known as I3, our daily news feed, and annual events, including our conference, Visions, Insights, and Perspectives Infrastructure, VIP Infrastructure, and our annual editorial advisory board meeting. For the last 30 years, again, for those less familiar with us, our objective has been to connect investors, consultants, and managers in infrastructure with insights, data, and most importantly, each other. The purpose of this video is to focus on the first objective and provide some insights and reflect on 2018. If you're already tired of watching me, I also write about this in the January issue of I3, so you can just read it there. Throughout the year, we've had many conversations with the readers of I3. During these conversations, I took extensive notes, not for news purposes, as these conversations were off the record, but more to see if there were patterns that might emerge throughout the year. So the three things that I noticed just based on conversations with you, the active investors, managers, consultants in this industry, the first one was the investor preference on how infrastructure fits into your portfolios. So really there's kind of a bifurcation between it being viewed more akin to fixed income, and then the other extreme is you have investors that view it more closely to private equity. So really kind of two extremes of the spectrum and how infrastructure is being viewed among the investors. The second theme noticed was there's obviously still a desire for more data, benchmarks, but even that isn't a static topic. It seems like people are getting more contrarian thinking in how to approach getting the data, getting benchmarks, and using those as they build out their portfolios. Number three is resiliency. So that kind of touches on the ESG aspect, but there's a few things that I thought were unique, not only on the ESG front, but just how to make portfolios and even assets themselves, the physical assets, more resilient in portfolios. So I guess first focusing on the investor preference. Again, this isn't necessarily groundbreaking, I don't think, but I just think it's worth noting in conversations we've had again throughout the year, just how it seems to be becoming more ingrained positions. One group of investors really seeing it more like a replacement for fixed income, whereas the other views it more higher risk, closer to private equity generating higher returns. On benchmarks, that was an area that I think there's been a lot of joking about it, that it's boring and people are tired of talking about it. But one key thing that we kind of noticed at the editorial board was obviously the discussion went for quite a while, but one thing that came out of it was one of the investors at the meeting had said that maybe the lack of a good benchmark isn't necessarily a bad thing. That really with infrastructure, unlike real estate where the assets are typically similar in their physical makeup, infrastructure has a lot of unique types of assets. That basically what he had said is that the lack of a benchmark or a good benchmark is more a feature and not a bug of the industry. So I thought that was pretty unique as far as a position to take, that not necessarily giving up on getting benchmark or index information, but just referring to it as maybe that's a good thing that you don't have a good benchmark. Presents more opportunity. Kind of the term we'd come up with at the editorial board was calling it the beautiful chaos of infrastructure. The third theme that seemed to emerge this year was focus on ESG and building resilient portfolios. One of the key things was there's obviously a lot of concern about how technology is going to impact a lot of portfolios, whether it's self-driving cars impacting parking garages or whatever that might impact as far as infrastructure investments. I think it's more interesting that there's a lot of futurist thinking, that it's not just kind of stagnant, that you have these great assets and you're just going to hold on to them, that the LPs and their managers are starting to think more long term. I think even at the conference, people had mentioned that they're bringing in people from different backgrounds, from the tech space, to just essentially war game what could happen to their portfolio if this technology emerged. We all have self-driving cars. What's going to happen to their assets? And then at an asset level, the other technologies that are being implemented, from kind of the building information modeling, things like that, to make these assets more efficient on the ground. So whether it's during a construction phase, during a renovation, just improving the asset management, improving the data that comes out of the physical assets to, again, create more yield for the portfolio. And one thing I did find interesting, again, going back to how the LPs are just trying to think outside the box, actually heard from a couple, because you want to build resilient portfolios, and obviously there's concerns about climate change, and one investor brought up that what happens if the opposite is true, that there's global cooling, that do we need to think of things like this? Not necessarily saying that that was his view of what would happen, but I think more at a high level, just the thinking that's going on is they're trying to think of all possibilities, that if you're preparing for one thing at a high level, you should probably at least consider the opposite happening. Again, not necessarily saying they thought that would happen, but they at least want to think about it and see if they're building a resilient enough portfolio to withstand any kind of change in the climate or what could happen. So yeah, those were the three key themes that I noticed in my conversations with the investors, consultants, managers in this industry. And I think another thing that seemed to emerge was just the investor confidence in how they're building their infrastructure portfolio. Thank you for your time. Again, I write about this in the January issue of i3. So thank you for your support this year, and looking forward to a good 2019. Thank you.